Welcome to the Knakal News Network. The Knakal News Network is brought to you by the Knakal Group, Cushman and Wakefield's #1 investment sales team.
Hi, I'm Jon Hageman, Executive Managing Director at Cushman and Wakefield. Welcome to the Knakal News Network. Today I'm here with Bob Knakal, Chairman of New York Investment Sales at Cushman and Wakefield. We're going to talk about the first quarter results on the outer boroughs. So last week we talked about the first quarter numbers citywide and how Manhattan was underperforming relative to the greater market, which means the outer boroughs must be doing pretty well. Can you fill us in on what those numbers look like?
Yeah, the outer boroughs, Hags, have really been doing well relative to Manhattan. And outer boroughs, we include northern Manhattan in that, then the dividing line being 96th Street on the east side, 110th Street on the west side. And I think if you look at the three main metrics that we track, if we look at number of properties sold, dollar volume, and value, we see differences in the three comparisons. On a number of properties sold basis, the outer boroughs are highly correlated with Manhattan so far in 17. On a dollar volume basis, though, we see that the outer boroughs are doing much better than Manhattan, and on a value basis, particularly over the last 2 years or so, the outer boroughs are doing much better than the Manhattan submarket is.
So let's talk about each of those. Let's talk about volume first relative to Manhattan and the rest of the market.
Sure. Well, if we look at the number of buildings sold, we see that in the first quarter of 2017, there were 697 buildings sold in the outer boroughs, which is on pace for about 2,788 for the year. That would be down 23% from last year and down 38% from the 4,520 that we saw in 2014, which was the peak in the outer boroughs. In the Manhattan submarket, in the first quarter of 2017, we've had 149 sales, which is on pace for 596 for the year. That would be down 22% from the 761 that we had in 2016, and down 45% from the peak year in 2015. So as we can see, those percentage drops in the numbers are fairly similar, so the outer boroughs are performing equivalently to Manhattan if we look just at the number of properties sold.
And now what about aggregate dollar volume?
When we look at dollar volume, the spread starts to become more transparent. In the first quarter of 2017, the dollar volume in the outer boroughs was $2.8 billion, on pace for $11.1 billion for the year. That would be down 39% from last year's $18.3 billion. And while 39% seems like a pretty big diminution in dollar volume, the numbers in Manhattan were worse. If we look at the first quarter of 2017, the dollar volume in Manhattan was only $4.3 billion, which is on a pace for $17.1 billion for the year. That would be down 57% from last year's $39.6 billion, and down a whopping 71% from 2015's record of $59.9 billion. So if we look at dollar volume, you see the spread start to grow.
Now we talked about number of properties sold and dollar volume. What about overall value?
Well, Hags, the appreciation in the outer boroughs in 2017 versus 2016 has been about 5%. We've seen values grow about 5% in the non-Manhattan submarkets. In Manhattan, value has been flat, so that's a small 5% difference. If we look at the Manhattan submarket, comparing the first quarter value to where values were in 2014, we see that Manhattan has grown by about 3% since 2014. In the outer boroughs, that percentage increase is 36%. So we've seen a big disparity in how value has grown in the outer boroughs compared to Manhattan.
And Bob, what do you think some of the reasons for that are?
Well, a number of factors. One, I think that if you look on a relative basis, rents in the outer boroughs have increased by a larger percentage. then rents have increased in Manhattan. We're even seeing a diminution in rents in some sectors, but the rent changes have been part of that. I think another part is that we've seen a tremendous amount of new construction in the outer boroughs. And so the marketplace is containing a different basket of properties, and that basket of properties is more valuable on a relative basis than we see in Manhattan. And also we've seen a tremendous wave in this cycle of conversion of industrial buildings and loft buildings in the outer boroughs into creative office, into residential, and that has really picked up the value of those properties very significantly. So I think there's been a real dynamic shift in the composition of buildings that we're seeing sell in the outer boroughs.
So it sounds like investors should maybe start focusing on the outer boroughs in northern Manhattan a little more.
Well, they have been, and I think they'll continue to look for opportunities in northern Manhattan and the outer boroughs. We've seen for the first time over the last year and a half, 2 years, that foreign capital is aggressively looking at opportunities outside of Manhattan, which is the first time we've seen that. So I expect those trends to continue, and I'm very, very bullish on what we're going to see in the outer boroughs moving forward. In summary, the activity in northern Manhattan and the outer boroughs has been significantly better than the activity that we've seen in Manhattan on a relative basis. The number of properties sold are highly correlated, but when we look at dollar volume and value, we see the outer boroughs in northern Manhattan performing relatively better than Manhattan. These dynamics are creating an ever-increasing appetite from investors to look at opportunities in these locations.
Thank you for joining us today. Tune in next week for another episode of the Knakal News Network.